There is one stock I cannot stop buying, one company I keep adding to, one investment I have doubled down on again and again and again. And every time I buy more, people tell me I am making a mistake. They tell me I am too concentrated, that I am taking too much risk, that I should diversify, that I should sell some and take profits. But I keep buying, I keep doubling down, because I understand something about this business that most investors do not. I see value that others miss. I see a future that Wall Street is not pricing in. And I have absolute conviction that 10 years from now, this is going to be one of the greatest investments I have ever made. So today, I am going to tell you exactly what stock I keep buying, why I have such high conviction, what the business is really worth, and why I believe this is a once-in-a-generation opportunity to buy a truly exceptional company at a reasonable price. Before I tell you which stock it is, I want to share a fundamental truth about investing that most people never learn. The biggest money in the stock market is not made from having a diversified portfolio of 50 stocks. It is not made from buying index funds and holding forever, and it is definitely not made from trading in and out trying to time every move. The biggest money, the wealth that changes your life and your family's life for generations, comes from finding 2 or 3 truly exceptional businesses and concentrating your capital in them for decades, letting them compound, riding out the volatility, ignoring the noise, and having the conviction to keep adding when opportunities present themselves. This goes against everything you have been taught. Wall Street tells you to diversify. Financial advisors tell you to spread your risk. The conventional wisdom says never have more than 5% in any one stock. But I am telling you that conventional wisdom is designed to produce conventional results, mediocre results. If you want extraordinary results, you have to be willing to do things differently. You have to concentrate, you have to have conviction, and you have to be right about the quality of the businesses you choose. Let me start by telling you how I think about position sizing and why it is the most important decision you will make as an investor. Because that is going to explain why I keep adding to this one stock instead of diversifying into other names. Most investors think diversification equals safety. They own 30 or 40 or 50 stocks because they think spreading their money around reduces risk. And on some level, that is true. If you own 50 stocks and one goes to zero, you only lose 2% of your portfolio. The mathematics of diversification tell us that owning more stocks reduces portfolio volatility, reduces the standard deviation of returns, makes your portfolio track closer to the broader market, and for 95% of investors, this is probably the right approach, because most people do not have the time, the skill, or the temperament to concentrate their portfolios in a few names. But here is what they miss. Here is what the textbooks and the financial advisors do not tell you. When you own 50 stocks, your winners do not matter either. If you have one stock that triples, it only moves your portfolio up 4%. You did all the work to find that winner. You did the research, you had the insight, you were right, and it barely made a difference to your wealth. That is the problem with over-diversification. You dilute your best ideas, you turn stock picking into index hugging, and you guarantee mediocre results. You are going to track the market minus fees. You might beat the market by 1 or 2% in a good year. You might lag by 1 or 2% in a bad year. But over time, you are basically going to get market returns. And if that is your goal, you should just buy an index fund and save yourself the time and effort of picking stocks. My approach is the opposite. And it is based on a simple realization I had early in my career. If I can find 5 or 10 truly exceptional businesses I understand deeply, businesses with durable competitive advantages, businesses run by excellent management teams, businesses trading at reasonable valuations, why would I dilute those insights by owning 40 other stocks I am less excited about? Why would I spread my capital across mediocre ideas just to hit some arbitrary diversification target? It makes no sense. I want concentrated positions in my very best ideas. If I find a business I truly understand, that has massive competitive advantages, that is run by excellent management, that is trading at a reasonable valuation, I want to own a lot of it, not 2% or 3%. I want 10% or 15% or even 20%. Because when I am right about a business like that, I want the win to be meaningful. I want it to move the needle. I want it to compound my wealth over decades. And the only way to do that is through concentration. Put big money behind your best ideas and let them run. That is how you build serious wealth in the stock market. Not by owning a little bit of everything, but by owning a lot of the very best things. Warren Buffett understood this. Charlie Munger understood this. Every great investor I have studied understood this. They concentrated their capital in their highest conviction ideas. They were not afraid to have 20 or 30% of their portfolio in one stock if they truly believed in it. And that concentration is what allowed them to compound wealth at rates far above the market average. Now, I want to be very clear about something. Concentration requires work. You cannot concentrate your portfolio in stocks you do not understand. You cannot just pick 3 random stocks and put a third of your money in each one. That would be reckless. Concentration only works when it is paired with deep understanding. You need to know the businesses you own better than almost anyone else. You need to understand the industry dynamics, the competitive landscape, the unit economics, the management quality, the growth drivers, the risks, everything. And you need to monitor these businesses continuously, not obsessively, not checking the stock price every day, but staying informed about the fundamentals. Reading the earnings reports, listening to the conference calls, visiting stores or facilities, talking to customers and competitors. This level of engagement is only possible if you limit yourself to a manageable number of holdings. I can deeply understand 8 or 10 businesses. I cannot deeply understand 50. So let me tell you about the stock I keep doubling down on. It is Chipotle Mexican Grill, ticker symbol CMG. And before you roll your eyes and think, oh, another investor talking about Chipotle, let me explain why this is not just another restaurant stock. This is one of the best businesses I have ever analyzed in my entire career. And I have been investing for over 30 years. I have studied thousands of companies. I have owned hundreds of stocks. And Chipotle stands out as truly exceptional. The unit economics are among the best I have seen in any industry. The brand strength is remarkable. The growth runway is massive. The management team is world-class. And the business model has characteristics that create a durable competitive advantage that will last for decades. I first bought Chipotle in 2016, and the circumstances of that purchase taught me one of the most important lessons about investing. Sometimes the best opportunities come disguised as disasters. The stock had crashed from $750 to $400 because of food safety issues. There had been E. coli outbreaks at some restaurants in the Pacific Northwest and other regions, norovirus incidents at locations in California and Massachusetts, salmonella cases linked to tomatoes. The media was all over it. CNN was running stories about Chipotle making people sick. Food safety experts were questioning their protocols. Health departments were investigating. Customers were scared, and rightly so. Nobody wants to get food poisoning from their lunch. The impact on the business was devastating. Same-store sales were down 20%. Traffic was plummeting. Lines that used to be out the door were gone. Restaurants that used to be packed at lunch were half empty. The stock was getting destroyed. Day after day, it kept falling. From 750 to 650, then to 550, then to 450, then to 400. Every day there was a new headline about the food safety crisis. Every day analysts were on television talking about permanent brand damage. Everyone on Wall Street was bearish. Analysts were downgrading the stock. Price targets were getting slashed. Research reports were coming out with titles like "The Chipotle Story is Over" and "Brand Damage May Be Permanent." Investment banks that had been bullish for years were turning negative. The conventional wisdom was that Chipotle's brand was permanently damaged, that customers would never come back, that the growth story was over, that even if they fixed the food safety issues, the psychological damage to the brand was irreversible. People were comparing it to Jack in the Box in the 1990s after their E. coli crisis. That company took years to recover and never regained its former glory. The assumption was that Chipotle would follow the same path, maybe worse. And I looked at all of this carnage, all of this negativity, all of this fear, and I saw opportunity. I saw a stock that had fallen 50% from its highs, trading at 15 times trough earnings. I saw a business model that had not changed. I saw a brand that was damaged but not destroyed. I saw a problem that was fixable. And most importantly, I saw that the market was extrapolating the current terrible conditions into the future forever. The market was assuming that sales would stay down 20%, that customers would never fully return, that this was the new normal. And I thought that assumption was wrong. I thought it was dramatically wrong. Because the food safety issues were temporary, they were operational failures, not fundamental flaws in the business model. And operational failures can be fixed. Here is what I understood that others missed. The food safety issues were real, they were serious, people got sick. That is not something to minimize or dismiss. Chipotle had screwed up. Their food handling protocols were inadequate, their supplier vetting was insufficient, their employee training had gaps. These were real operational failures that needed to be addressed. But, and this is the critical insight, they were fixable. This was not a fundamental flaw in the business model. This was not like owning a tobacco company where the core product is harmful. This was not like owning a newspaper in the internet age where the business model is obsolete. This was an operational execution problem in a business model that was otherwise exceptional. Let me explain what Chipotle did to fix the problem, because this is important. They did not just put out a press release and hope things got better. They took dramatic action. First, they brought in food safety consultants, the best in the world, people who had worked with the CDC, people who understood pathogen control and supply chain safety at a level that Chipotle's internal team did not. These consultants did a complete audit of every aspect of Chipotle's food handling from farm to restaurant. They identified weaknesses, they made recommendations, and Chipotle implemented every single one. Second, they completely overhauled their food safety protocols. They implemented high-resolution testing of ingredients before they ever got to restaurants. They tested for E. coli, salmonella, norovirus, everything. Any supplier whose ingredients failed, testing was immediately dropped. No second chances, no exceptions. This created a much more rigorous supply chain. Third, they changed food handling procedures in the restaurants. They mandated washing and sanitizing procedures that were far more stringent than industry standard. They required employees to change gloves more frequently. They implemented temperature controls and monitoring. They added checks and verification steps at multiple points in the preparation process. Fourth, and this is the most important part, they changed the culture around food safety. Before the crisis, food safety was something that was talked about but not obsessively monitored. After the crisis, it became the #1 priority. Management made it clear that nothing mattered more than food safety. Not sales, not speed of service, not cost control. Food safety was paramount. And they backed that up with actions. They hired a food safety officer at the executive level. They created a food safety team. They invested millions in training. They made food safety part of every manager's performance review. This cultural shift was real and it was permanent. Now, I watched all of this happen. I read every press release. I listened to every conference call. I talked to restaurant managers and employees. I talked to suppliers. I did my homework. And I concluded that Chipotle was genuinely fixing the problem. This was not a public relations exercise. This was a real operational transformation. And I believe that once customers saw that Chipotle was safe again, they would come back. Because the food was still great, the experience was still great, the value proposition was still compelling. Fresh ingredients, made to order, no freezers or microwaves, customizable bowls and burritos, fast casual dining at a reasonable price, protein options that were high quality, chicken and steak and barbacoa, vegetarian options with sofritas and veggies, the ability to build exactly what you want. That value proposition had not changed. The temporary food safety crisis did not change the fundamental strength of the business. So I started buying. I bought at $400. I did not try to catch the exact bottom. I did not wait for some magical signal that the coast was clear. I started building a position based on my conviction that the business was fixable and undervalued. Then the stock fell to 350. The negativity continued. More bad headlines, more analyst downgrades, more fear in the market, and I bought more. I added to my position. Then it kept falling to 280, and I bought even more. People thought I was crazy. Why are you catching a falling knife? Why are you buying a stock that is clearly broken? Do you not read the news? Do you not see what is happening? But I had conviction. I had done the work. I understood the business. I knew the food safety issues would be resolved. I knew customers would come back. I knew sales would recover. And I knew that when they did, the stock was going to rocket higher. Let me tell you about the conversations I had during this period. I remember talking to another hedge fund manager at a conference in early 2017. He asked me what I was buying. I told him Chipotle. He literally laughed. He said, "You are buying Chipotle? That stock is dead. The brand is finished. Customers are never coming back. You are throwing your money away." And I said, "We will see. I am willing to bet that you are wrong." And he said, "Well, it is your money to lose." That interaction stuck with me because it perfectly encapsulated the sentiment at the time. Everyone thought I was making a huge mistake. Everyone thought the brand damage was permanent. Everyone was convinced that Chipotle would never recover. And that extreme negativity, that consensus bearishness, that is often the best time to buy. When everyone is on one side of the boat, when the stock has been beaten down so badly that people cannot even imagine it recovering. That is when you find the greatest opportunities. By early 2017, I had built a 10% position in Chipotle. It was my largest holding, bigger than anything else in my portfolio. People asked me if I was worried about being so concentrated in one name, in a stock that was still struggling, in a company facing an uncertain recovery, and I said no. I am not worried, I am confident. Because I understand this business better than almost anyone on Wall Street. I have done the work, I have built the model, I have stress tested my assumptions, I know what I own, and when you truly know what you own, you can hold with conviction. You do not panic when the stock goes down. You do not worry about short-term volatility. You focus on the long-term value of the business, and you let time prove you right. It took about a year for the turnaround to really take hold. Through 2017 and into 2018, Chipotle slowly rebuilt trust with customers. Same-store sales started to improve. First, they went from negative 20% to negative 10%, then to flat, then to positive low single digits. The trends were improving quarter by quarter. You could see it in the numbers. You could see it in the restaurants. Lines were getting longer again. The lunch rush was coming back. Digital orders were growing. The business was recovering. And the stock started to recover too. It went from 280 to 350, then to 400, then to 500. By late 2018, I was up significantly on my position. I had bought in the high 200 seconds to low 400 seconds, and the stock was now over 500. I was sitting on a 50 to 75% gain, depending on which tranche. And that is when people started telling me to sell. You had a great trade, lock in your profits, take the win and move on. But I did not sell, I held, because the thesis was just getting started. Here's what I saw. Chipotle was not just recovering from a food safety crisis, they were fundamentally improving the business. They had hired a new CEO, Brian Niccol, who came from Taco Bell. He was an operator, he understood restaurants, he understood customer experience, he understood technology, he understood marketing, and he was implementing changes that were going to transform Chipotle. Digital ordering, mobile app, delivery partnerships with DoorDash and Uber Eats, second make lines dedicated to digital orders so they did not slow down the in-store experience, drive-through lanes called Chipotle lanes for picking up digital orders without getting out of your car. These innovations were going to make Chipotle faster and more convenient. They were going to drive sales growth beyond just recovering from the food safety issues. They were going to fundamentally change what Chipotle could be. The unit economics were also exceptional, and this is something I want to spend time on because it is the foundation of why Chipotle is such a great business. An average Chipotle restaurant does about $2.5 to $3 million in sales per year. Some high-volume locations in Manhattan or college towns do $4 million or more. The restaurant-level margins, what we call four-wall margins, are around 25 to 26%. That means each restaurant generates $625,000 to $750,000 in profit annually. Now here is the beautiful part. It costs about $1 million to build a new Chipotle, maybe $1.2 million in expensive markets. So the payback period is less than 2 years. You invest $1 million to $1.2 million, and within 18 to 24 months, you are getting your money back. Then that restaurant generates $750,000 per year in profit for the next 20 or 30 years. That is an incredible return on invested capital. Let me put this in perspective. Most restaurants in the industry have payback periods of 4 to 5 years. Some never pay back, some lose money. Chipotle's 2-year payback is exceptional. It means they can grow aggressively. They can open 200 or 250 or 300 new restaurants per year, and the returns on those investments are outstanding. It also means they are not dependent on external capital. They can fund their growth from internal cash flow. The business throws off so much cash that they can reinvest in new restaurants, buy back stock, and still build a cash balance. That is a sign of a truly great business. When you do not need outside capital to grow, when the business funds itself, and Chipotle was nowhere near saturated. They had about 2,500 restaurants at the time. Management thought they could get to 6,000 or 7,000 eventually in North America alone. I did my own analysis. I looked at population density. I looked at where Chipotle had locations and where they did not. I looked at markets that were underserved, and I concluded that 7,000 was probably conservative. They could potentially get to 8,000 or even 10,000 if they executed well. That meant they could more than triple their restaurant count, more than triple their revenue, more than triple their earnings. This was a growth story, not a recovery story. Yes, they were recovering from the food safety crisis. But beyond that recovery, there was a massive growth runway. New restaurants, same-store sales growth from digital and menu innovation, margin expansion from scale and efficiency. This was a compounding machine, and the market was not pricing that in. The stock was trading at maybe 30 times earnings. For a company that could grow earnings at 15 to 20% per year for a decade, that was cheap, so I held, and I bought more. In 2019, when the stock pulled back to 650, I added to my position. Why was I buying at higher prices than my original cost basis? Because the business was better. The thesis was playing out. The digital transformation was happening. Brian Niccol was executing. The unit economics were improving. The growth was accelerating. I was more bullish at 650 than I had been at 400 because I had more confidence that the future I had envisioned was actually going to happen. In 2020, during the COVID crash, when Chipotle fell from 900 to 550, I backed up the truck. I bought aggressively. People thought I was insane. Why are you buying restaurants during a pandemic? Restaurants are shutting down. Dining rooms are closed. This is the worst possible time to own restaurants. But I understood something that others did not. Chipotle was actually going to benefit from COVID. They had a drive-through model with Chipotlanes. They had a strong digital business. People could order online and pick up without going inside. They could get delivery. This was perfect for a pandemic environment. While other restaurants were struggling because dine-in was shut down and they did not have drive-thrus or delivery infrastructure, Chipotle was thriving. Their digital sales exploded. They went from 20% of revenue pre-COVID to over 50% during the peak of the pandemic. They were proving that the digital investments were paying off. They were proving that the second make line dedicated to digital orders was working. They were taking market share from competitors who could not adapt. So when the stock crashed to 550, I bought because I knew Chipotle was going to come out of COVID stronger than they went in. The stock recovered quickly. By late 2020, Chipotle was back over $1,000, then $1,200, then $1,500. It kept going, and I kept holding. People kept telling me to sell. You are up 5 times from your cost basis in the 200 seconds and 300 seconds. Take your profit, diversify, move on. But I did not sell. Why would I sell a great business that is compounding at 20% per year? Why would I give up those future gains? Every time someone told me to sell, I asked them the same question. What should I buy instead? What other business do I understand as well as Chipotle? What other business has unit economics this good? What other business has this growth runway? And they never had a good answer. They would say, well, diversify into other things. But that is not a strategy. That is just diluting my best idea for the sake of diversification. I held, and in 2021 and 2022, I actually added more at higher prices. I bought Chipotle at $1,400, at $1,600, at $1,800. People thought I was insane. Why are you buying at all-time highs? Why are you paying 40 or 50 times earnings? Have you lost your mind? Because the business was even better than when I first bought it. The digital business was now huge and permanent. The unit economics were better because of operating leverage. The growth runway was clear. Management was executing flawlessly, and I believe the stock was still undervalued despite the run-up. Let me explain why. Let me walk you through the math that justified buying at those higher prices. Chipotle at that time had about 3,000 restaurants. They were opening 250 to 300 new restaurants per year. At that pace, they would have 6,000 to 7,000 restaurants in 12 to 15 years. That is a doubling of the store base. Plus, same-store sales were growing at 5 to 7% per year. Some of that was traffic growth from digital and better execution. Some of that was pricing to offset inflation. So if you have 6% annual growth from new units and 6% from same-store sales, you have 12% revenue growth. And because Chipotle has operating leverage, meaning fixed costs get spread over a larger base, earnings grow faster than revenue, probably 15 to 18% per year. Compound 18% for 12 years, and your earnings go up about 7 times. So if Chipotle was earning $35 per share at that time, in 12 years, they could be earning $245 per share. Now, what multiple should we pay for that? If Chipotle is still growing at 10 to 12% per year at that point, a 30 times earnings multiple is reasonable, maybe even conservative for a best-in-class business with that kind of growth and returns on capital. So $245 in earnings times 30 equals $7,350 per share. The stock was at 1,800 at the time. That implied more than a 4 times return over 12 years, about 13% annualized. That is a great return, better than the stock market average. And that was using conservative assumptions. But here's the thing. I thought my assumptions were conservative. I thought Chipotle could get to 8,000 or even 10,000 restaurants. I thought same-store sales growth could be higher as they innovated with menu and digital. I thought margins could expand further as they got more scale and leverage. And I thought the market would pay more than 30 times for this kind of quality and growth, maybe 40 times. If I was right about any of those things, the stock could go much higher, maybe 10,000 or 12,000. That would be a 6 or 7 times return, 16 to 18% annualized. Those are spectacular returns. So even at $1,800, even at what looked like a high valuation, the stock was still a buy based on the fundamentals. That is why I kept adding, not because I was trying to trade or time the market, but because the math worked, the business was compounding, and I wanted to own more of it. Now let me tell you what makes Chipotle so special beyond just the numbers. Because the real reason I keep doubling down is not the math, it is the quality of the business. Let me tell you what makes Chipotle exceptional. First, they have a fanatical customer base. People love Chipotle, not like love. They go multiple times per week, they have their regular orders, they customize every detail. They post about it on social media. There are Reddit threads dedicated to Chipotle orders. There are TikTok videos about the best combinations. This is not just a restaurant. This is a brand that people have an emotional connection with. That loyalty is incredibly valuable. It means Chipotle has pricing power. They can raise prices 5 or 6%, and customers keep coming. Traffic does not fall. People complain a little bit, but they still visit. That is rare in the restaurant industry. Most restaurants are commodities. If you raise prices, customers go somewhere else. Chipotle is a brand. They have earned the right to price at a premium, and they use that pricing power wisely. They raise prices to offset inflation in food and labor costs. They maintain their margins, and customers accept it because they value the experience. Second, the food is actually good and fresh. This is not frozen processed food reheated in a microwave. This is fresh ingredients prepared in front of you. You can see them making your bowl or burrito. You know what is going into it. The chicken is grilled fresh. The steak is seared. The guacamole is made in-house every day. The salsa is prepared fresh. There are no freezers in a Chipotle. There are no microwaves. Everything is made from scratch using real ingredients. In an era where consumers care more about health and transparency and knowing what is in their food, this is a huge advantage. Chipotle is positioned perfectly for the trends. Fresh, customizable, no antibiotics in the meat. Organic beans, locally sourced produce when possible. This resonates with younger consumers, especially millennials and Gen Z. And younger consumers are forming habits now that will last for decades. If you start eating Chipotle in college, you will probably still be eating Chipotle in your 40 seconds and 50 seconds. That long-term customer relationship is incredibly valuable. Third, the unit economics are outstanding. I already mentioned this, but it is worth repeating and expanding on. A 2-year payback on a $1 million investment is incredible. Most restaurants take 4 or 5 years to pay back. Some never do. Chipotle's speed and efficiency allow them to generate high volumes in a small footprint. The average Chipotle does $2.5 million in sales in a 2,500 square foot space. That is $1,000 per square foot. Most fast food restaurants do $500 to $700 per square foot. Chipotle is almost double. This efficiency is a huge competitive advantage, and it gets better as digital ordering reduces friction and increases throughput. Think about what happens when 50% of your orders come through digital channels. Those orders do not slow down the main make line. They are handled on a second make line in the back. This means you can serve more customers in the same space. You can increase sales per square foot even further. You can drive margins higher because you are leveraging your fixed costs better. That is what is happening at Chipotle. Digital is not just a convenience feature. It is fundamentally improving the economics of the business. Fourth, there is a long growth runway. 3,500 restaurants today in a country of 330 million people. McDonald's has 14,000 locations in the US. Subway has over 20,000. Starbucks has 16,000. Chipotle has massive room to grow. They are not even close to saturation. And the cohort data supports this. When Chipotle enters a new market, sales build over time. Year 1 might be 2 million. Year 3 might be 2.5 million. Year 5 might be 3 million. As the brand becomes more familiar, as word of mouth spreads, as the location becomes part of people's routines. This means that even in mature markets like California or Texas, where Chipotle has been for 20 years, there is still room for more locations. And in newer markets like the Southeast or the Midwest, the growth potential is even larger. Internationally, they have barely scratched the surface. A few locations in Canada and Europe, if they can crack the international market, if they can replicate the US model in other countries, the runway extends dramatically. I am not counting on international in my valuation because it is uncertain and execution is hard. But if they figure it out, it is massive upside optionality. Imagine Chipotle with 5,000 locations in the US and 5,000 internationally. That is a $10 billion plus revenue business, $100 plus in earnings per share. A $3,000 to $4,000 stock at a 30 to 40 times multiple. That is the long-term opportunity. Fifth, the management team is excellent. Brian Niccol is one of the best restaurant operators in the world. He has a track record of driving growth and improving operations. At Taco Bell, he grew sales significantly. He improved margins. He drove innovation with new products and marketing. He understands the fast food and fast casual business at a deep level. He knows how to balance growth with profitability. He knows how to drive traffic. He knows how to use technology. Since he joined Chipotle, he has executed flawlessly. Digital sales went from 10% to over 35% of revenue. He launched Chipotle, which are now in over 500 locations and drive significantly higher volumes. He improved the menu with things like carne asada and cauliflower rice. He strengthened the supply chain. He improved restaurant operations and speed of service. He invested in people and training. He has done everything right. And he is supported by a strong team. The CFO, Jack Hartung, is excellent. He has been with Chipotle for years. He understands the business. He is disciplined about capital allocation. The rest of the executive team is strong. They are not empire building. They are not chasing vanity metrics. They are focused on what matters: unit growth, same-store sales, margins, returns on invested capital, shareholder returns. That focus and discipline matters enormously. Great businesses with bad management eventually become mediocre businesses. Great businesses with great management become exceptional businesses. Chipotle has both. Sixth, there are multiple levers for growth. New restaurants are the obvious one, but there is so much more. Same-store sales growth from digital, from menu innovation, from day parts expansion. Chipotle is mostly a lunch and dinner business. Breakfast is tiny. Late night is underpenetrated. If they can drive more traffic in those time periods, that is incremental revenue using the same real estate and largely the same fixed costs. The economics of driving traffic outside peak hours are excellent. Margin expansion from scale is another lever. As they grow, they get better purchasing power with suppliers. A 3,000 unit chain has more negotiating leverage than a 2,000 unit chain. They get more leverage on technology investments. The cost of building the digital infrastructure gets spread over more units. Fixed costs at corporate get spread over a larger base. Margins can go from 26% restaurant level to 28% or 30% over time. Every point of margin expansion is huge for earnings. If you are doing $10 billion in revenue and you improve margins by 2 points, that is $200 million in additional profit, just from operating leverage. No additional sales required. There are loyalty programs to drive frequency. Chipotle Rewards has over 30 million members. They can use data to understand customer preferences. They can send targeted offers to drive repeat visits. They can reward high-frequency customers. If you can get a customer to visit 1 additional time per month, that is 12 additional visits per year. Multiply that across millions of customers and you have enormous sales growth. Menu innovation is another lever. Chipotle has been conservative on menu. They stick to what they do well. But there is room for limited time offers. Seasonal items, new proteins, new salsas. Each of these can drive trial and incremental visits. And if something really works, it can become a permanent menu item. Carne asada was a limited time offer. It tested well. Now it is on the permanent menu in many markets. That one addition probably drives 50 to 100 million in incremental revenue. Each of these levers is small individually. 1 point of margin here, 1 new menu item there, 1 more visit per customer per year. But together they add up to a business that can compound at high rates for a very long time. This is not a one-trick pony. This is not a business that only has one way to grow. Chipotle has optionality. They have multiple paths to drive value. And that diversification of growth drivers reduces risk and increases the durability of the business model. Now, let me address the bear case. because I have heard all the arguments against Chipotle, and I want to explain why I am not worried. The first argument is valuation. Chipotle trades at 50 to 60 times earnings. That is expensive. If growth slows or margins compress, the stock could get crushed. I acknowledge this risk. Valuation is the biggest risk in owning Chipotle. But I think people misunderstand what you are buying. You are not buying current earnings. You are buying a stream of cash flows that will grow at 15 to 18% per year for the next decade or longer. When you discount those cash flows back at a reasonable rate, say 9 or 10%, Chipotle is not that expensive. It is fairly valued. Maybe even slightly cheap if you are optimistic about the long term. Yes, you are paying up for quality, but quality is worth paying for. I would much rather pay 50 times for a business growing at 18% than 20 times for a business growing at 5%. The 50 times multiple compresses much slower when the earnings are growing fast. In 5 years, you are paying 25 times if earnings double. That is reasonable. The 20 times multiple on the slow grower is still 20 times in 5 years. You have not created any value. You have just collected dividends. The second argument is competition. Fast casual Mexican is crowded. Qdoba, Moe's, local chains. Taco Bell is coming after this space with their cantina concept. How does Chipotle maintain its edge? My answer is that Chipotle is so far ahead that competition is not a major threat. Qdoba and Moe's are fine, but they do not have the brand strength or the unit economics. They do not have the same customer loyalty. They do not have the same scale. They are subscale. They are struggling. Qdoba has gone through multiple ownership changes. That is not a sign of a healthy business. Taco Bell is a different segment, cheaper, lower quality, smaller portions, a different customer. Someone who eats at Taco Bell is probably not the same person who eats at Chipotle. There is some overlap, but not as much as people think. The real competition is from new concepts and other cuisines. Mediterranean fast casual like Cava, Asian bowls, salad chains like Sweetgreen. These are legitimate competitors. They are targeting the same customer. The health-conscious, willing to pay a premium, wants customization customer. But even there, Chipotle has scale advantages. They have 3,500 restaurants. Cava has 300. Sweetgreen has 200. That scale matters for purchasing, for marketing, for technology investment, for brand awareness. Chipotle can invest in things that smaller chains cannot afford. They can negotiate better pricing with suppliers. They can invest in national marketing campaigns. They can build a world-class digital platform. That scale creates a widening moat. The bigger you are, the more advantages you have. And it is very hard for smaller players to catch up. Not impossible, but hard. So I am not worried about competition in the near term. Could a new concept emerge that disrupts Chipotle? Theoretically, yes, but I have not seen it, and I am watching the space closely. The third argument is food safety risk. Chipotle has had issues before. What if it happens again? This is a real risk. Food safety is critical in restaurants. One bad outbreak could tank the stock. I saw it happen in 2016. I know it is possible, but Chipotle has invested heavily in food safety since those incidents. They have protocols and systems that are best in class. They test ingredients rigorously. They monitor suppliers constantly. They train employees extensively. They have redundancies built into the system. Is the risk zero? No. Nothing in life is zero risk, but it is much lower than it was. And I am comfortable taking that risk given the upside. If you are not willing to take any risk, you should not invest in individual stocks. You should own treasury bonds. But if you want to build wealth, you have to be willing to take calculated risks. And Chipotle's food safety risk is a calculated risk that I am willing to take. The fourth argument is labor cost pressure. Minimum wages are rising in many states. California is going to $20 per hour for fast food workers. Labor is a big cost for restaurants. If wages go up 20 or 30%, margins will get squeezed. This is true. Labor inflation is real. But Chipotle has pricing power. They can pass through labor cost increases to customers. We have seen this already. Chipotle has raised prices 5 to 8% per year over the past few years. California prices are higher than Texas prices because costs are higher. Customers have not pushed back. Traffic is still growing. Same-store sales are still positive. As long as Chipotle delivers a great product and experience, they can raise prices to offset labor costs. This is not a low-margin commodity business where you cannot raise prices. This is a branded experience where customers will pay more for quality. So yes, Labor inflation is a headwind, but it is a manageable headwind. And over time, technology can help. Automated make lines, robotics in the kitchen, order ahead and pick up to reduce labor at peak times. These things can offset some of the labor cost increases. The fifth argument is growth saturation. Chipotle says they can get to 7,000 locations in North America. What if that is overly optimistic? What if they hit saturation at 5,000 or 6,000? What if new unit volumes are lower than historical levels because the best markets are already built out? Then growth slows and the stock multiple compresses. This is possible. Real estate is hard. Finding good locations is hard. Maybe they cannot open 300 restaurants per year forever. Maybe it slows to 200 or 150. But even if growth slows, Chipotle is still compounding earnings at double digits from same-store sales and margin expansion. I am not betting on them getting to 10,000 locations. I would love it if they did, but I am not counting on it. I am betting on them being a durable, high-quality business that grows at 10 to 12% for a very long time. As long as they can do that, the stock will compound nicely. Will it compound at 18% forever? Probably not. But 12 to 15%, very achievable, and that is still great. So those are the bear arguments. I have thought about all of them carefully. I have stress-tested my assumptions, and I am still buying because the bull case is so much stronger, the business is exceptional, the growth is visible, the management is excellent, the risks are manageable, and the valuation, while not cheap, is reasonable for the quality. I would much rather pay a fair price for a great business than a cheap price for a mediocre business. And Chipotle is a great business, one of the best I have seen in restaurants, possibly the best. Let me tell you about a recent conversation that crystallized my thinking. I was talking to another investor a few months ago, smart guy, successful track record. He asked me, Bill, why do you keep buying Chipotle at these prices? You already have a huge position. You are up massively from your initial cost basis. Why not take some profits and diversify? Reduce your risk. Lock in your gains. And I said, diversify into what? What other business do I understand as well as I understand Chipotle? What other business has unit economics this good? What other business has this long a growth runway? What other business has this quality of management? Give me a name. Tell me what I should buy instead. And he could not. He said, well, I do not know, but you are too concentrated. You have too much in one stock. What if something goes wrong? And I said, that is exactly the point. You want me to sell my highest conviction idea, a business I understand deeply, to buy something you cannot even name, something I probably understand less well, something that probably has worse economics, something that probably has a shorter growth runway? That makes no sense. I hold winners and I add to them when I have capital and conviction. I do not sell winners to buy losers or even to buy average businesses. I compound my capital in the very best businesses I can find. And right now, Chipotle is the best business I own. It is my highest conviction idea. So why would I reduce my position? This is a lesson I learned from Warren Buffett. He talks about finding wonderful businesses and holding them forever, letting them compound, not trading in and out, not trying to time the market, not diversifying for the sake of diversification, just owning quality and being patient. Buffett held Coca-Cola for decades. He held American Express for decades. He held See's Candies for decades. He did not sell when the stocks went up 50% or doubled or tripled. He held because the businesses kept compounding. Every year they were worth more. Every year they generated more cash. Every year the moat got wider. And that is what I am doing with Chipotle. I am holding because it keeps compounding. Every year the business is bigger and more profitable. Every year there are more restaurants and more customers. Every year the digital business gets stronger. Every year the brand gets more valuable. Why would I interrupt that compounding by selling? I would just create a tax bill and then have to find something else to buy. Much better to hold and let it run. There is another reason I keep doubling down. The opportunity cost of not being fully invested in my best idea. Let me explain what I mean. I have a certain amount of capital to deploy. I can put it in Chipotle, or I can put it in 10 other stocks. If I put it in Chipotle, and Chipotle compounds at 18% per year, my capital doubles every 4 years. In 12 years, it is up 7 times. But if I spread that same capital across 10 stocks, and they average 10% per year, my capital only triples in 12 years. The difference between 7 times and 3 times is enormous. That is the cost of diversification. You give up the compounding power of your best ideas. And over long periods, that cost is huge. It is the difference between wealth and extraordinary wealth. Now, some people would say that I am taking too much risk by having such a large position in one stock. If Chipotle blows up, I lose a lot of money. That is true. But I have done the work to understand the risks. I know this business inside and out. I know what could go wrong: food safety, competition, labor costs, saturation, execution. I have thought through all of these scenarios, and I have sized my position accordingly. I have enough in Chipotle that if I am right, it really matters. It moves my net worth significantly, but not so much that if I am wrong, I am wiped out. I have other positions. I have diversification at the portfolio level. I own Hilton. I own restaurant brands. I own other businesses. But within my highest conviction ideas, I am concentrated. That is the balance. Concentrate in your best ideas, but do not bet the farm on any one thing. I also think about risk differently than most people. Most people think about volatility as risk, the stock going up and down, standard deviation of returns, beta. But volatility is not risk. Volatility is just noise. Permanent loss of capital is risk. Chipotle stock might drop 30% in a market correction. That is volatility. It happens. Stocks go up and down. But is the business impaired? No. Is Chipotle going to have fewer restaurants? No. Are customers going to stop eating there? No. Are the unit economics going to deteriorate? No. So the volatility is just temporary mark-to-market fluctuations. It is not real economic loss. It is actually an opportunity to buy more at better prices. I have bought Chipotle when it was down 20 or 30% multiple times. In 2016 during the food safety crisis, in March 2020 during the COVID crash, in May 2022 when tech stocks sold off. Every time I bought on the dip, the stock recovered and went higher because the business was sound, the fundamentals were intact. The temporary stock price fluctuations do not matter if you have a long time horizon and you understand what you own. The real risk with Chipotle would be if something fundamentally changed with the business. If customers stopped liking the food, if a competitor emerged with a clearly superior model and started taking share, if food safety became an unsolvable problem that kept recurring, if regulation made the business uneconomic, those would be real risks, permanent risks, risks that would impair the long-term value of the business. And if I saw any of those emerging, I would sell. I would cut my losses and move on. I am not married to any stock. I am not emotionally attached. I am willing to admit when I am wrong, but I do not see any of those risks materializing. I see a business that is getting stronger every year. Management is executing. Customers love the brand. Competition is not a threat. The growth runway is clear. So I keep holding and I keep buying. Let me tell you what I think Chipotle looks like in 10 years. I think they have 7,000 restaurants, maybe 8,000 if they execute really well or crack international. Revenue is $20 to $25 billion. Up from $9 billion today. Restaurant level margins are 28%, up from 26% today because of scale and operating leverage. Net margins are 15%, up from 13% today. Earnings are $200 per share. Maybe more if margins expand further. The stock trades at 35 to 40 times earnings because they are still growing at 10 to 12% per year and the market recognizes the quality. That puts the stock at $7,000 to $8,000. From $2,300 today, that is more than a triple in 10 years. About 12% annualized returns. Plus they might start paying a dividend by then as the growth moderates and they have excess cash. So total returns of 13 to 14% per year, that is a great outcome. That is wealth compounding. That is what I am signing up for. But there is upside to that scenario. That is my base case. What if things go better than expected? What if Chipotle cracks international and opens 2,000 stores outside North America? What if digital innovation drives even higher margins than I am modeling? What if they figure out breakfast and that becomes a meaningful day part? What if loyalty programs drive frequency even higher? If any of those things happen, revenue could be $30 billion, margins could be 16%, earnings could be $300 per share. At 40 times, the stock is $12,000. That is a 5 times return in 10 years, 18% annualized. That would be an incredible outcome, an absolute home run. I am not counting on it, but it is possible. And that optionality is part of what I am paying for when I buy at current prices. The other thing I love about Chipotle is that there are no existential threats on the horizon. This is not a business that is going to be disrupted by technology. People are not going to stop eating. They are not going to stop wanting fresh, fast, customizable meals. Food is a basic human need. And the way Chipotle delivers food, the experience they create, is durable. Chipotle is not a newspaper facing the internet. They are not a taxi company facing Uber. They are not a retailer facing Amazon. This is a physical service that cannot be replicated digitally. You cannot download a burrito. Yes, you can order digitally, and Chipotle has embraced that. But at the end of the day, someone has to make the food and someone has to deliver it, or you have to pick it up. That physical component creates a moat. It creates barriers to entry. It creates a sustainable business model. Food is also one of the most resilient categories in an economic downturn. People might cut back on travel or new cars or home renovations when the economy weakens, but they still eat. They might trade down from fine dining to fast casual, but they still go to restaurants. In fact, fast casual often benefits in recessions as people trade down from more expensive options. Chipotle is positioned well for any economic environment. They are affordable enough that they are not the first thing cut in a recession, but they are premium enough that they are a small treat. A $10 or $12 meal that feels like an indulgence without breaking the bank. That positioning is sweet spot. It makes the business durable through cycles. I also think about what happens if I am wrong. What is the downside scenario? Let us say Chipotle only gets to 5,000 restaurants instead of 7,000 or 8,000. Same-store sales growth slows to 3% instead of 5 to 6%. Margins do not expand and stay flat at 26%. They are basically a slower growing, mature business in 10 years. What is it worth? Maybe 25 times earnings. Earnings are $100 per share instead of $200. Stock is $2,500 from $2,300 today. That is basically flat. I make no money for 10 years. That is the bear case. And even in that scenario, I do not lose money. I just do not make money. My capital is preserved. I just missed out on the opportunity cost of deploying it elsewhere. The risk reward is still favorable. Big upside if things go well, flat to small downside if things go poorly. That is an asymmetric bet. That is the kind of investment I want to make. Limited downside, significant upside. As long as I do not lose money, I am fine. And in my base case and upside case, I make a lot of money. So that is why I keep doubling down on Chipotle. Because it is the best business I know. Because it is compounding at high rates. Because the growth runway is long. Because the management is excellent. Because the risks are manageable. Because the unit economics are exceptional. Because the brand is strong and getting stronger. Because I have conviction, true conviction based on deep understanding. I am not buying Chipotle because some analyst recommended it. I am not buying because it is in the S&P 500 and I need to own it to track the index. I am not buying because everyone else is buying and I am afraid of missing out. I am buying because I have done the work. I have visited dozens of restaurants over the years. I have talked to employees and customers. I have modeled the unit economics in detail. I have studied the competition. I have met with management multiple times. I have read every earnings transcript and investor presentation for the past 8 years. I know this business. And when you truly know a business, you can own it with confidence. You can hold through volatility. You can add on weakness. You can ignore the noise. You can let it compound. That is the secret to building wealth in the stock market. It is not complicated. Find a few exceptional businesses, really understand them, buy them at reasonable prices, and hold for decades. Let compounding do its work. Do not trade in and out trying to catch every move. Do not try to time the market. Do not let fear or greed drive your decisions. Just own quality and be patient. That is what I am doing with Chipotle, and that is what I will keep doing for as long as the thesis remains intact. I will keep doubling down. I will keep buying when I have capital and the valuation is reasonable, because I know that 10 years from now, 20 years from now, I will be glad I did. And that is the only opinion that matters. Not what Wall Street thinks today. Not what the stock does tomorrow or next month or next quarter, but whether this is going to compound my wealth over the long term. Whether this is going to be one of the best investments I ever made, and I am absolutely certain that it will.